All right, folks. Today we're going to look at Chapter 16, Credit in America. And so we're going to look specifically at the what and the why of credit, and then types and sources of credit that exist in America today. So we're going to look at the history, the role of credit, and then advantages and disadvantages of using credit. And credit is a pretty simple concept. Essentially, it's using somebody else's money with the agreement that you'll pay it back later. And credit has been around for a long time. Typically, it originated with a very simple form of credit, where somebody perhaps in a general store, the owner would say, you can open a line of credit here and then pay me back at a particular time. So maybe you don't have to pay me right now for the items that you're buying, but you will pay me back later. And typically they didn't charge interest. But today, about 80% of all purchases in America are using credit, and it's a little bit more complicated. And credit lenders today do charge interest, which is how they exist as a business. There's two main people that you need to, or two main roles that you need to understand: the debtor and the creditor. The debtor, it's pretty simple, is the person who borrows the money. The creditor is the person that loans the money. And so the main issues here are the creditor charges money for the service. That's in the form of interest and fees. And then the debtor has to be qualified to receive credit today. And we'll look at what that means. To qualify, you have to have the ability to repay the loan. And that's based on your income, your current financial position, and then any type of collateral that you might have. The income sources of income include your job, interests that you may be making on savings or stocks or anything like that, dividends that you're getting from stocks, alimony, which would be like payments from a spouse or ex wife or husband, and then royalties could be things, money that you're making on you know some kind of thing that you've put out there, a product or a business or something. So that's your cash inflow. And when your earnings exceed your expenses, then you have the capacity to take on debt. But if your expenses are higher than the amount of money that you're earning, then you're in trouble and you may not qualify for credit. Your financial position is made up of your capital, which is the value of all of the property that you possess after deducting your debts. So that's your bank accounts, your investments, your real estate. If you have capital, then the creditor understands that you're responsible, and that lending to you sort of makes sense. Your debt represents the cash outflow that will be compared to your cash inflow. So if the amount of debt you're taking on doesn't sort of match the inflow, the income that you have, then you may not get credit. Collateral is property that's pledged to assure repayment of a loan. So, in other words, if a creditor is giving you money, they want some guarantee that you're going to be able to pay it back. So if you put up collateral, then what's happening is that you are saying to them, if I don't pay it back, then you can take this. So perhaps collateral would be property or something, like perhaps you own a home and you're taking out a big loan and you say, if I don't pay it, I'm putting up my house as collateral. You can take my house if I don't pay it back. Once you've completed a credit purchase, then you owe money to the creditor. And the principal, which is the amount that you borrowed, plus interest. And that's how the creditor is typically making money. The finance charge is the total amount of all interest and fees you pay for the use of credit. So you may have to pay a fee up front, and then you may have interest of a certain percentage on the loan that you're paying. The finance charge includes all of that. There are some major advantages and disadvantages to credit. Advantages are you have higher purchasing power. You can get funds in an emergency. It's more convenient. You don't have to pay right away, so that's deferred billing. Some others. Disadvantages, typically credit costs more because you have to pay interest and maybe fees up front. Finance charges are more complicated and higher than if you just use cash. It can tie up your income, and there's a risk of you overspending because you're not seeing that money leave your account right away. So there can be sort of a false sense of security. We're going to look at different types and sources of credit here. There's open-ended credit, there's closed-ended credit, and then there's something called service credit. So open-end credit is when a borrower can use credit up to a stated limit. So typically that would be like a credit card or a charge card that will say you have a $10,000 or $20,000 credit limit, and therefore you can use all the credit you want up to that dollar amount. A credit card is a form of borrowing that usually involves interest and other charges. So the terms of the card agreement affect the overall cost of the credit that you're going to be using. So some credit cards will have annual fees that you have to pay. Some will have really high. They all have really high interest rates, but typically interest rates on credit card don't kick in unless you aren't paying it monthly, unless you aren't actually paying off the balance as you go. Credit card agreements that you want to think about is number one, the APR, which is the annual percentage rate, is the cost of the credit as a yearly percentage. So what is the interest rate going to be on this credit card if you don't pay it off in time? The grace period is the time frame where you have to pay your current balance to incur no interest charges. So the grace period is important, but if you're planning on incurring charges, if you're planning on buying something that you can't pay for, you should never do that. First of all, you should only be using a credit card when you know that you have the money to pay for these things, and you're using credit card as sort of a convenient way to do that. Fees are also something you want to think about. Different cards have different annual fees. Perhaps there's a transaction fee or penalty fee. And you want to also think about how are they calculating the finance charge. Some credit cards, you have to pay an annual fee, but the rewards kind of make up for it. Sometimes the benefits outweigh the price. Closed-end credit is a loan for a specific amount that has to be repaid by a stated due date. So open-end credit is sort of you've got maybe $10,000 or $20,000 of credit to do what you want with. Closed-end credit is this specific amount. You cannot go over, and you have to pay it by a certain date. It's also called installment credit. It's not continuous borrowing like credit cards are. It's often used to pay for really expensive items. So if you get a car, you are going to be getting credit, usually from a bank or from a car dealership, that perhaps is $10,000, and you have to pay that $10,000 off by a certain date. Same thing if you're buying maybe furniture or major appliances for your home. Service credit involves providing a service for which you will pay later. So utility services are things like trash pickup or electric bills or cable or things like that. You are given the service and then you pay at the end of the month. So that's sort of an example of service credit. There's a lot of different sources of credit. There's retail stores that could be offering credit, like credit cards, credit card companies, banks, finance companies, pawnbrokers, etc. Just quickly go through this. Retail stores, like department stores, like perhaps you go to, Old Navy, they'll have their own credit card, typically. And usually their credit card involves rewards that you can earn for Old Navy. So you could receive discounts, you might get advance notice of sales, but you don't have to use their credit card to pay for purchases at their store. It's just if you want, additional discounts, sometimes it makes sense to do that. Credit card companies like Visa, MasterCard, American Express, these are all things you've heard of. They usually offer different types of credit cards depending on what you're looking for. Banks and credit unions offer credit cards like Bank of America or maybe TD Bank. They all have their own credit cards, usually with credit card companies. They'll also offer closed-end loans for major purchases. Finance companies are organizations that make high-risk consumer loans. So there are a couple different types. There's consumer finance and there's sales finance companies. So these would be if you are sort of in a desperate situation and you really need cash. Typically, a finance company will give you a loan, but for a very, very high interest rate. And usually people that take out loans like that end up being in worse financial positions in the future. A loan shark is an unlicensed lender, basically a lender who charges illegally high interest rates. So that would be if perhaps you get a loan from somebody not through a bank or any financial institutions, and they say, yeah, we'll lend you this money, but you're going to owe us this much. And then, it's illegal, and typically they have people who are going around and collecting those debts. And you don't want to be in that situation. A usury law is a state law that sets a maximum interest rate that may be charged for consumer loans. And so loan sharks are not sort of subject to those usury laws. There are pawn shops or pawnbrokers. These are legal businesses that make high interest loans based on the value of possessions. So if you bring in something valuable like a camera or jewelry or radio or TV, something collectible, they will pawn that, meaning they will hold that collector item, give you a certain loan based on the value of that item with an interest rate, and then when you pay back the loan, you get back the item. Or a lot of pawn shops will also just buy your stuff too. Private lenders are very common. So that would be like parents, relatives, friends, and private lenders are a good option if those are available to you, because typically they may not charge interest or require collateral, or maybe they'll charge some interest but a very small amount, which is always good. You can also get credit from life insurance policies, from borrowing against a deposit or borrowing against an asset, meaning let's say you're paying off your mortgage. As you pay off your house, you grow the amount of funds that you actually you grow the amount that you actually own of your home, and then you can take a loan sort of borrowed against that, sort of as collateral. And that's it in terms of chapter 16. So next chapter we'll look a little bit more at credit in some detail.